Hey, Jason Williams here with Ironclad Underwriting. I have a whole course curriculum on underwriting commercial properties, and one whole section is on due diligence. And what is due diligence and why does it matter? Due diligence is finding out all the information you need about your property, about your investment before you move forward, so that you know if you should move forward or not. And that's kind of just a grandiose definition, but it goes a little bit further than that. What exactly is it and how does it help? First thing is it helps with risk mitigation. It helps identify financial, legal, market, and operational costs. And whenever you figure out your operational risks or what you need to take care of, you can add them to your business plan and you develop your business plan from that. Another reason why you want to do your due diligence is for accurate valuation, so that you can know if the purchase price that they're asking and what you're offering is in line with fair market value, making sure that the NOI, the net operating income, and the cap rate coincide with what's going on in that market and that property. And so it's very easy to find properties that are they're overpriced. And what a lot of times I've been seeing lately is, in our economic times, we have people who are in debt to the bank, risk of being foreclosed on, so they're trying to sell it, but they need to make a certain price to pay off the debt, to pay off the bank note. And the property performance is not what it should be so that you can do the purchase at that price. So there's a disconnect going on. And so you're gonna wanna do your due diligence to make sure you're not gonna fall into a trap where you pay more than what it's worth because the property does not do very well. So you wanna base your price on the T12, which is the trailing 12-month profit and loss statement, and figure it out from there. You don't wanna just go off of what the seller's selling it for, because there's a good chance that they're overpricing it. Another reason why you want to do your due diligence, or how it helps, is you ensure compliance. Suppose you're buying a property and the previous owner, maybe a couple owners before, did some changes to the property, but they didn't go through the proper codes, they didn't get the proper permits, and now you buy a property that has these buildings that aren't built to code, were never permitted, and now you want to add on. So you go through those proper channels, and all of a sudden you realize that, hey, you can be in deep water because you didn't know there were some additions that weren't originally on the survey or whatever, and so that can cause some legal issues. Or zoning. Suppose you are zoned in light multifamily and you add in heavy multifamily or dense multifamily. Guess what? That is a big legal battle because you are not zoned for what you're supposed to be. Another thing is environmental. Suppose there was a gas station that was across the street and you end up buying the parking lot or something, but there's still the gas tank underneath, and you have to do your environmental analysis, your phase 1, and if there's a gas tank in there, definitely a phase 2. That could be some big issues there as well. So I mentioned this before. Another reason is the financial health. So this is where the T12 and the rent roll comes into play. You want to verify that everything is the way it is. You want to do a lease audit. You want to make sure, hey, all these residents are who they say they are. They don't have additional pets. They have the bank stubs to prove that they have the income needed to satisfy the requirements. And then you also want to make sure that the property's cash flowing, or if it's not cash flowing, does your business plan account for it cash flowing? And so this is what y'all have to do. And I'm not saying you have to do all of this and it all has to be perfect, but if it's not perfect, or if your business plan allows for it, this is how you account for it. I know a lot of people, or I know some people who their business plan is to drop occupancy to 0 and rehab every unit and lease it up and then sell it once it's about 70-80% leased up. Sometimes 90 if they're trying to get someone in on agency debt. So there are some business plans that account for bad financials, and if that's you, kudos. If it's not you, you need to be aware of it. Another due diligence, and this one's a hard one because this one's affected by macroeconomics as well as local economics, is what is your market conditions? So we bought a property. Market conditions were fairly decent. Rents on the rise. We're in a pretty stable market. It's not a big one like DFW or Austin, which could be pretty volatile, but the economy tanked, and so our occupancy ended up tanking. We couldn't push rents the way we were planning on. In fact, we were having to give concessions and lower rents just to get people in, and that was killer. So some of these things aren't predictable, but you do your due diligence, you can face them off as best you can. But again, everything's a risk. If it was easy, if it was 100% pure success, everybody would do it. So Another thing to look at in due diligence is your management and operational efficiency. So this is vetting the property management company, and I did a little walk and talk on the property management company earlier. You might want to catch that. And you want to make sure that your property management can do what they say they're going to do. You want to make sure that they're running efficiently, that their expenses aren't out of line with what the market should be, what their payroll is. You don't want to have a whole bunch of $75,000 a year employees for 50 units, because that's just unsustainable. And so you need to go in. This is in the small market, and some of the bigger markets that might be sustainable, but when you're getting less than $1,000 a rent a unit, that's not sustainable. Basically, the management company needs to increase revenue and decrease expenses. They also have to have strong management. You need a strong regional manager who can handle the day-to-day operations of handling your maintenance men, handling your lease managers, sometimes even handling the residents, because people are people. Maintenance men and lease managers are people. A lot of times they're the kind of people who are going to be renting from you. They're not entrepreneurial minded. They want to do the bare minimum to get by, or a lot of times. So you need to make sure you have management that can handle that and keep everyone on track. Otherwise, things go south really quickly. And the last thing, and I sort of touched on this before, due diligence helps is so that you can figure out your exit strategy. Is your exit strategy to do value add up to about 80% renovated units, so that you give some meat on the bone to the next operator who's going to come in and buy it in 5 to 7 years? Is your strategy a long-term hold where you can withstand some of the short-term market changes because you know you're going to hold it for 20, 30, 40, 50 years? You're going to create a legacy for your family. So all of this is found out in due diligence, and if it matches with your business plan, or if you can tailor your business plan around it, that's how you move forward. Again, if you have any questions, I'm Jason Williams with Ironclad Underwriting, and you can find me on LinkedIn, Instagram, YouTube, and at ironcladunderwriting.com. I'll catch you later. Bye.